If you're holding out hope for a bull market, then please pay close attention. According to legendary investor Mark Chaikin, who Jim Cramer famously said he'd never bet against, a new wave of volatility is coming for the stock market and investors need to act immediately. Mark's prediction is based on an indicator that has only triggered a handful of times in the last 72 years, with a 100% success rate for predicting where stocks will go next. During Mark's 50-year career, he's worked alongside some of the biggest investors in history, including Paul Tudor Jones and Michael Steinhardt. In fact, Mark invented one of Wall Street's most popular indicators for picking stocks, still used by hedge funds, banks, and brokerage sites, and today found in every Bloomberg terminal on the planet. Now, Mark's inviting you to watch his brand new event as he explains exactly what the next wave of volatility will look like and where it will send stocks in the coming weeks. He's even sharing one of his favorite ideas free for those who tune in. He says this idea could create bigger gains than anything he's used his power gauge system for until now by turning the coming market volatility to your advantage. And you don't have to wait until March 28th to get started. For a sneak peek of Mark's big reveal, go to chaikinevent.com. Again, that's chaikinevent.com. Hi, this is Daniela Cambone, excited to be bringing you coverage from the Swiss Mining Institute here in Zurich, Switzerland. And joining me now is a keynote speaker at the event, Tavi Costa of Crescat Capital, no stranger to the junior mining sector, but with a macro overview. So thank you so much, Tavi, for being with me today.
Thanks for having me. Looking forward to this.
I mean, look at this. We're in the belly of the beast. We are in Zurich, where all the action is unfolding right now. I want to talk, obviously, the mining sector, but first, just want to get your global outlook on things right now.
Yeah.
How do you see things evolving right now?
Things are firming up for precious metals. I think there's a lot of themes in the global macro world right now.
Yeah.
One of the things I continue to be concerned is the equity market as a whole. I think we really had 5 very bad decades for the stock market throughout history. And I think we're probably going to have another one this time. If you break that down into 2 categories, those happen in inflationary periods and also during periods when you had very speculative assets in terms of valuations. And we have both issues today. And so I think investors have been conditioned to value financial assets with low cost of capital environment along with high growth. I just don't think that will be the case in the next decade. So there will be a lot of what we call the gray rotation through a lot of issues with the domino effect of things of not only interest rates being higher, but really this growth to value transition along with the 60-40 portfolios failing. I think all that is, and I think the next shoe to drop is probably 3 important themes. It's private equity, mega caps, and also the corporate bond market. So those are 3 parts of the market that we are very concerned about.
And I love how you were saying how you feel there's just become too much complacency when it comes to the FAANG stock.
Again, I've never seen a time when, look, majority of the FAANG stocks, if you look at the median basis, the valuation right now, it's about 25 or so times earnings. Those evaluations usually of times when, as I said, when rates are very low, cost of capital is very cheap, and you are growing. If you look at the fundamentals of most of those companies, it is deteriorating. Right now, the median revenue growth is about to turn negative for the first time. And so all those issues are getting involved along with what I think it's a risk of an earnings recession as well.
Well, let's talk about that. We have an inverted yield curve since June.
Yeah.
Basically a signal of an impending recession. How far away are we? I mean, what camp are you in when we talk recession?
Well, we calculate, I think the research of yield curve inversions is fascinating, first and foremost. I think it's one of the best indicators that leads to or precedes a recession in general. But more importantly, I think you have to look at the percentage of inversions in the yield curve. So meaning you look at all possible spreads in the yield curve, not just one. And there's 45 spreads, and you see how many of those are negative. And you look back throughout history, every time we go above 70% of inversions in the overall treasury curve, usually, or not usually, every single time we've had a recession. And we backtested that. And this is interesting for financial media, but for a portfolio manager, it doesn't mean much. And you have to go further and think, what do you do? And what we found is that the best positioning is the gold to S&P 500 ratio during times, right after you get the 70% handle. We got that in November. Since then, the gold to S&P 500 ratio has been moving higher. Throughout history, every time we've had that, usually the return is about 75% in the next 2 years. I think there is even a case where both legs of this trade could work, where gold could go up with markets going lower. And that happened in 73, 74, a stagflationary environment. And during the tech bust, which was a time when valuations for commodities were cheap relative to technology, which sound familiar. And so I think we're going to see something similar now, and investors need to look back at that commodities to equity ratio and think, how do I really find the biggest inefficiencies in both sides of that trade? So to me, it's private equity, corporate bonds, and mega caps on the short side. Alongside metals and mining is probably the best opportunity.
I have a specific question on the metal side. I read how you said you became interested in silver back in 2019 based on what the Fed did. Why?
So I was kind of interested in silver, but really the turn for me was when the Fed was forced to basically become much more dovish, given the fact that we were seeing issues in the economy emerging. And if you think, I call this a trifecta of macro imbalances, what we have currently. We've seen issues like debt problems in the past, we've had valuation problems in the past, and we had inflation problems in the past, but we've never seen them all at once. And to me, that creates real political constraints for the Fed to fight inflation, number one, and it always has to resort back to financial repression. And so when you think back at times when we had those issues, which really never happened to the degree that we have currently, but times that we had somewhat of the issues we have currently, tangible assets were very hot. It was a time when you wanted to be investing in things that are tangible, usually commodities. And so, and you would look back as well in terms of allocations, and a lot of investors and large institutions don't have a focus on commodities. Very few people understand that market. Even the labor trends. I mean, there's a lack of geologists in space. We were just talking about this. So, I think this creates a lot of opportunities, and there's a lot of ways to invest in the space. Some people will focus in energy, some others metals and mining, uranium, gold itself, silver. And so to me, I think it's best to be looking for silver in the ground, gold and silver in the ground, and even the green metals as well. But meaning with the idea of, well, you have exploration, high quality assets. We know that the majors have underinvested really over the kind of a chronic underinvestment period over the last 10 years or so, which caused, extreme conservatism, lack of discoveries, and the need for them to replenish their reserves. So we're going to see a time when everyone is going to be looking to new high quality assets to then replenish their reserves and go back to a time when production goes higher, not lower. And so in order to see that, we need to see exploration. So I think a lot of those assets are priced for failure right now. And if you add the geology knowledge, which I think it's the most important part, because you can then improve your odds, you can create essentially a hybrid venture capital approach. The difference is, instead of investing in expensive technology companies, you're investing in resources.
Let me ask you this. How do we bring the investors into the space? Because they're looking at the returns in the junior mining space and they're like, we're not going to touch this. Why would I be in this?
And making money is the best marketing, as you know. So as people make money, you have more people getting attracted to that industry or sector. And so that is an issue. I think, first of all, there's a lot of things that need to happen. Maybe an M&A time where you see more merger and acquisitions of some of those high quality names. That's one. We know the majors have capital. We know they're making money. They have the best cash levels we've seen in history. They might create that opportunity. I also think there's opportunities in terms of major discoveries. We haven't seen a major discovery that creates that excitement in the markets and what's next, and someone really becoming a multi, maybe even a billionaire in this industry over a short period of time that creates that excitement. We haven't seen much of that.
We haven't had it for a long time.
And the other issue is, we were talking about this earlier too, majority of the CEOs of the companies, even we invest in companies we talk to in the exploration phase, are sellers, not builders. I don't think Ross Beatty became Ross Beatty selling an asset for 10x. He built mines, and we need more of those folks.
Exactly.
And so
I absolutely agree. Where is that new generation? I ask myself all the time, like, who will be the new Tom Kaplans, Frank Giustras, Beatties?
Well, I don't know who are the next ones, but maybe I am basically trying to do that with Crescat. And I think if you look back in the history of even Newmont, it started as a fund.
Right.
And so we've taken stakes, 15 to 20% stakes in names that we think are high quality, that could be company maker types of projects. And I think that's where it starts. It's finding those discoveries from 10, 15, even sub $10 million market cap that become 300, 500, maybe a few $1 billion. And rather than selling to majors, well, let's create the next company. And so I think there's a lot of things that could be done. I'm not claiming I will be any of that. I'm just saying I will certainly be attempting to do so, and not myself, but Kevin and Quentin, our team, is very focused in figuring out a way to be creative.
Just a last question, as an operator in the space, I mean, obviously we're doing this interview in Switzerland against the backdrop of, I call it a bank sprint, not a bank run, for how quickly we've seen the collapse of some of these banks. Are you concerned about the economy as a whole? I mean, what direction are we headed in? What is the signaling?
Well, it's concerning because, there's a question that I think I ask myself a lot. Is the monetary conditions too loose or too tight? Sam Zell is a famous investor that I really respect, and said a sentence that really resonated to me was, one thing is to take interest rates from 0 to 4%. The other thing is when you stay in that range of 4 to 6%, which is where we are, and why raising rates 25 or 50 basis points or cutting rates 25 to 50 basis points is sort of meaningless, because we are at that range. And given the level of imbalances we have in the global economy, not just in the US, it's hard to believe we're not going to see more things unfolding. And so the question really is then, I think it's too tight for financial assets at these valuations, but also I have a very strong view that the inflation problem, while it may decelerate and accelerate at times, it is structural, not cyclical, meaning we're going to see higher inflation for longer. And if that's the case, it changes the landscape of cost of capital, and it changes how we value everything. And I think we just have market participants that are not used to a market like this. And so there's going to be a lot of readjustments of prices and fundamentals.
Tavi Costa of Crescat Capital, thank you so much for joining me in beautiful Zurich. I mean, look at this backdrop.
I can't believe we're here.
I can't either. Thank you so much, Tavi. And thank you for watching. We'll have more coverage coming your way, so be sure to stay tuned to the Daniela Cambone Show here on Stansberry Research. And don't forget to sign up at danielacambone.com to stay on top of it all. That's it for me. See you soon.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.